Hi everyone, we're Fanatic, a youth-run 501c3 nonprofit that aims to educate the next generation of youth on crucial financial topics through chapters, publications, interactive workshops, newsletters, and speaker events. We hope to provide accessible, informative financial literacy knowledge and raise awareness about financial literacy. FinaticTalks is Fanatic's very own set of finance-related speaker events. Today's event is co-hosted by myself and Alex.
Yeah, welcome to FinaticTalks Professor Speaker Series. Joining us today is Francis Longstaff, Distinguished Professor of Finance at UCLA. Francis previously served in the fixed income derivative sector at Salomon Brothers and is a pioneer in quantitative finance. Thank you so much for taking the time to speak with us.
Pleasure.
Yeah, so the topic of this specific talk is derivatives and financial modeling. What exactly is a financial derivative?
Well, financial derivatives are kind of interesting investments. As opposed to being a security, they're actually just contracts. And so examples of those might be call options, put options. We have swap contracts, futures and forward contracts, but pretty much everything that isn't just a straight security like a stock or a bond. And essentially the cash flows from these types of investments are derived from other types of things, like a stock option. Its value depends on the underlying stock price. And so we kind of view it as, well, we just call it derivative because it's kind of based on the prices of some other securities.
Yeah, so what are some of the major risks and benefits involved with trading them?
Well, there's a couple of types of things that are unique to derivatives. I'm going to focus on probably maybe more like options, since those are probably the most familiar types of derivatives, or futures contracts. What's unique about them, they have some advantages and disadvantages. Number one is that they're often a little bit more complicated. Like stock options behave in ways that are very counterintuitive, just to pique your interest. Normally, if you have an investment, and let's say all of the cash flows from the investment were suddenly become more risky. So you're investing in a stock, and the company somehow changes its business model and becomes more risky. Everything else being held fixed, you would imagine that that company's stock price should go down, right? That's risk is not a good thing, and if something becomes riskier, you probably wouldn't be willing to pay as much for it. It works just the reverse with stock options. If the stock suddenly becomes more volatile, more noisy, and more risk, this price of the option actually goes up. It's very counterintuitive. So modeling and understanding them is one thing that's a challenge for derivatives because they're a little more complicated. Number two is that they have the advantage, however, is that since they are contracts, they can be potentially an infinite supply, right? There's only so many 30-year treasury bonds in existence. And if Alex, you were to buy all $50 billion of the current 30-year treasury bond, nobody else could get them. They'd have to come to you, and you could probably charge a pretty good price for them. That doesn't happen with derivatives because you can kind of manufacture them out of thin air. So there's no danger of having sort of a short squeeze or somebody cornering the market. So that actually has some really important advantages. So that's a plus and a minus. Other things that are nice about derivatives is that they are often very, very easy to trade. You may be familiar with the idea of, borrowing stock and short selling it, right? People, we saw a lot of that with GameStop going on last year. People were trying to borrow the stock and selling it, and then later have to buy it back. But that's really difficult to do when you are, with GameStop, it was a real problem trying to short the stock. With derivatives, if you just did it synthetically by the derivatives market, by maybe investing in a put option or selling call options, or some of these markets, you can do this in the futures market. it's really easy to do it. So there's some trading advantages there that you can go long and short in huge size without having to sort of run around and try to get your hands on the actual security. So a lot of institutional investors use derivatives for that. For example, if you think, you get some information that you think that the market's going to sell off in the next 10 minutes, well, you could spend a lot of time trying to maybe sell a bunch of stocks or something, but that would be hard to do. Or you could just go short the stock market via a futures contract, and that you can do with huge size almost instantaneously. So derivatives just have a lot of trading benefits for large institutions. Now, on the downside is that it takes a lot more infrastructure. These contracts, you have to have sort of a agreement set up with brokers or other institutional players, and there's a lot of infrastructure involved. So those are just kind of a couple of pluses and minuses, I think, talk about the derivatives markets.
All right, so how does financial modeling tie into derivatives?
To kind of understand the risk and return profile, often you have to sort of use a model. It's let's say just the Black-Scholes formula for stock options, to use one example. It gives you a way of sort of thinking about how the prices of these derivatives should behave, and they might do unexpected things. Think back to the example I mentioned about volatility and stock options. It does the reverse of what your intuition suggests. But if you look through the model kind of helps you understand what's actually going on and what's causing that. So models can be very useful because it just kind of helps us understand the basics of how these contracts work, how their cash flows behave. We get a handle on kind of what they're doing. And that's important because some of these contracts have just a lot of moving parts. Like a swap contract where you have cash flows on both sides coming in, going out, and without having a model, it's just hard to look at all these dozens of cash flows and make sense out of what's going on.
Got it. If there's one tip that you would tell anyone about derivatives and specifically trading derivatives, what would that tip be?
Well, I would be probably the first to caution, particularly retail investors, that because of the nature of the markets, and now it takes a lot of infrastructure and modeling and risk management, they're going to be very expensive to trade. And so the implicit trading costs for these can be extremely high, 5, 10, 20% sometimes. So people are excited about buying options, but when they start reading the fine print, seeing how much they're paying for that should give them pause. So I would watch out for the trading costs associated with looking at derivatives.
Got it. Sounds good. So building off of financial modeling, we want to talk about one of your well-known models, the Longstaff and Schwartz model. The math behind the model is probably too complex for most high schoolers to understand, but just generally speaking, what is the purpose of the model and how can it be used in financial markets?
Well, I think you may be thinking of the paper we have where we're looking at pricing American options. Is that the one? Okay, yeah. That's one. It's one we developed on. I was working on Wall Street. Yeah, this kind of goes to a classic investment or decision problem that we call like the optimal stopping problem. With an American option, you can exercise the option at any time, but you only get one bite at the apple. Once you've exercised your option, it's gone. So the question is, what if you do it too early? Well, you could actually be throwing away value, or if you do it too late, reverse. It's kind of like the classic problem. Imagine somebody was going to pay you $1 million, and what you're supposed to do is walk down a cornfield, okay? And you get to look at the corn, and you're going to get paid $1 million if you can pick the biggest ear of corn. So you get to walk down, it's a 1 mile row of corn. But the point is, you can't ever retrace your step. You got to move forward. You got to pick the largest ear of corn, but if you pass it, you can't go back. So you only get one chance. So what's the optimal thing to do? You know, obviously it probably isn't to pick it the first one you see. But if you wait too long, you might pass it. So there's a question of how do you learn from your experience as you're going along? So the problem that we were looking at, and this was kind of a Wall Street issue, is that we have a lot of American style options that you can exercise at any time. But to figure out the math of when is the best time to sort of exercise the option, you know, pick the ear of corn or pull the trigger on the decision, you know, how do you learn about that? What do you make the best choices? It was very, very complicated and involved some of the hardest math that anyone was using on Wall Street. So we just found kind of a simple way of reducing the problem to something that's just very, very manageable. And that's kind of what that paper, that research is all about. So something we did on Wall Street, because we kept interviewing people when I was on the street, and they kept telling us that, oh, it's not possible to do this. And finally, after hearing about 3 or 4 people tell me that in job interviews, we just sort of said, you know, I'm not sure I believe that. So we went out and found a way to do it. So that was kind of a challenge that we got from interviewing people from like Lehman Brothers that just didn't believe it was possible to do it by simulation.
Got it. So what was like the true inspiration of creating the model? Was it something that like you personally experienced, or how did you come up with it?
Yeah, we were actually, you know, when I was on Wall Street, we were trading some derivatives that the essence was trying to figure out when is the right time to pull the trigger and exercise the option. Not too early, not too late, what would be just the right way of doing it. So it was a very practical problem we were all facing.
Makes sense, makes sense. And from getting the inspiration to create the model, what was the full process to going from that all the way to implementation?
Well, so we did some rudimentary stuff on Wall Street. When I came back from Wall Street to go back to UCLA, I worked with one of my colleagues, and we sort of started putting together a horse race. We basically said, okay, here's how you would do it with conventional techniques, where there's like maybe an option on one stock, where we knew what the answer was, and then we could do it with our technique and compare and say, okay, those works great. Then we'd say, let's look at a problem where we maybe have 2 stocks. That's much harder to do with conventional techniques, models. And that took a lot of programming to do it the conventional way. And then it was trivial to do it with our approach. And again, compare the results and getting similar answers. Then we moved to a 3-dimensional problem where we had 3 stocks. And boy, that just like took weeks to kind of code that up using conventional techniques. It was really pushing technical limits of what we could do. You know, it took hours for the software to run and everything, whereas we used our technique, which just took a couple of seconds. And after that, we got kind of crazy, and we said, okay, let's look at a problem that we can't even begin to do with normal techniques that might have like 20 stocks in it, right? It just completely would be impossible, and show that it was just a piece of cake, just a couple lines of code, and we could redo the whole thing with our technique and go to places that people had never been before. So kind of just doing the horse race and showing that we're getting, like, when we know what the answer was, we could demonstrate we're getting the right answer, but then show that the technique is totally scalable, and it just sort of then everything caught on very quickly and everybody was using it. Then we spent a lot of time going around Wall Street and presenting it to all of the firms, and everybody started using the model.
Yeah, sounds awesome. So do you think the process of financial modeling itself will ever be fully automated?
I don't think so. You know, yeah, obviously we use a lot of automation, you know, have to crunch the numbers, a lot of numbers. But well, I think one of the important reasons for using financial models is it just kind of gives you a bit of a reality check. This is where the judgment comes into looking at things. That, we used to argue that, we know that models are not capturing 100% reality, but that's not what they're supposed to do, right? They're supposed to kind of be a simplification and capture the essence of what's going on. So even if a model, all models are wrong technically, something my PhD advisor, Gene Fama, would often say, all models are wrong, right? He won the Nobel Prize a few years ago. But his point of view is models, that's not what they're supposed to do. They're not supposed to be right or wrong. It's whether are they useful or not useful. And so models, even if they're not completely correct, can be useful because it lets you focus on the key issues or ask the right questions. And so even if a model isn't completely correct or doesn't capture everything, it can be useful. So that's how models get used to kind of guide our thinking, and to completely automate them is in danger of kind of missing something important. Use the model to kind of figure out what it is you don't know. Now, once you've got the model figured out, then sure, you just program it up and you can crunch the numbers and use it. But sometimes it's a good way of exploring. It's kind of like a hypothesis, like the model says that this should happen. And then you go and look at it and suddenly it isn't happening. And then, something's wrong. So that's the kind of stuff that human intelligence kind of needs to help with.
Yep, that makes a lot of sense. So transitioning more to your personal experience, earlier in your career, you served at the Chicago Board of Trade. So what exactly is the Chicago Board of Trade, and what did you do? What did you do there?
Yeah, so the Chicago Board of Trade is part of the CME, the Chicago Mercantile Exchange. Now, that was a futures market. So people were just trading futures on, agricultural, been around for 100 years, 150 years, financials like stock indexes, on bonds. So just buying and selling commodities in the futures exchange. So I was a researcher there and kind of would develop some of the contracts. They were always trying new things to see if they could attract enough trading interest. So I wrote some proposals for futures contracts on muni bonds and things of that sort.
Got it. So you also worked
with regulation.
All right, got it. So you also worked in Wall Street at Salomon Brothers in fixed income derivatives.
Yeah.
Wall Street, especially at these big hedge funds and banks, is stereotyped as this relentless and unforgiving environment. Do these stereotypes hold true to your experience at Wall Street?
Not really. I think most of the time it was they were all, when there were crises, it was all hands on deck. Everybody had to work around the clock. But most of the time it was a pretty reasonable world, and worked with some really good people, very smart, trying to develop new markets, new products, new contracts. I thought people were great to work with, very smart, very good friends, learned a lot of good stuff. So, everybody's mileage might vary depending on where they are, but mine was actually a very pleasant experience, and worked with some good people and stayed friends with them for years and years. So worked with them in other capacities as well. So I certainly enjoyed being on what we call the sell side, which is kind of the Wall Street broker dealers. And then eventually everybody moves on to what we call the buy side, where you're actually the investor, running a mutual fund or a hedge fund and buying products from Wall Street.
Gotcha. So diving a little bit more into your work at Salomon Brothers, a lot of people see fixed income securities like bonds as minimum volatility securities. So how does Wall Street, or more specifically Salomon Brothers, make money in the fixed income derivatives market?
Well, the sell side, the Wall Street types, pretty much they try to make their money mostly from just the trading flow, bid-ask spreads, right? They make a small amount on each contract, derivative, or trade that they do. So that's the bulk of how they make their money. Various times, people will sometimes try to take what we call a proprietary position. They'll actually take some risk and hope that they're on the right side of the market. That's kind of been de-emphasized the last decade or so since the financial crisis. But that's kind of the other way that people would tend to make money. But these days, I think it's mostly just kind of coming up with good ideas, good products, good execution, and just trying to make a little commission, a bid-ask spread on every trade. So serving clients is kind of where they make the money there, as opposed to taking risk.
Okay, got it. So Coinbase, the US's largest crypto exchange, just recently announced that they will be offering crypto derivatives to US customers. And traditional financial derivatives are based on assets like stocks and bonds, which actually have intrinsic value. How does the fact that crypto doesn't necessarily have intrinsic value change the idea and dynamic of crypto derivatives?
Yeah, good question. I don't know much about this. I just had lunch or dinner a couple of weeks ago with Robert Merton, who got the Nobel Prize for his work on option prices. So Bob and I were sitting there across the table. Funny story, like the next day he tested positive for COVID, but I didn't, thank goodness. I'm glad I was on the other side of the table. But yeah, he was looking at me saying the same thing, like, I've been looking into this crypto stuff. I don't understand it. So I figured Bob Merton, Nobel Prize, doesn't understand it. I sure don't understand it. And, I just don't have any view on that. We have, all sorts of derivatives. You're right, Alex, we've got derivatives, let's say options or futures on stocks, on bonds. We also have them on kind of less tangible things like electricity or volatility or credit spreads or things of that sort. So things that aren't, are on the VIX, the volatility index, things that aren't actually the price of a traded security. So those are kind of second generation derivatives. We've seen, derivatives on things like inflation or, housing prices and stuff like that. But yeah, this is kind of going quite a bit farther down the road on stuff where you just really don't know what the value is. I guess it's comparable to, it's not even like gold necessarily. Gold doesn't pay any dividends or coupons. It's hard to figure out what the actual value is, but it's kind of a step further down that path. And certainly the people I know researching this are kind of scratching their heads going like, I'm not sure we really understand what's going on here.
Makes sense. So how would, in general sense, how would you best advise young finance investing enthusiasts to get into investing in general, but more specifically derivatives?
Well, I'm not sure I would advocate, I think derivatives are very useful from an institutional perspective. I'm not sure I would really recommend them all that much as a retail product, individual investors. I'm kind of maybe more traditional, thinking that, stocks, bonds, real estate, kind of a standard boring portfolio like that is probably the best way to go to eventually build wealth. Usually when we see people starting to add options and things like that into their personal portfolios, they seem to be moving away from the idea of just holding a well-diversified portfolio and kind of staying the course. When you start chasing returns and, selling stocks that went down and trying to chase stocks that went up, you end up burning a lot of money, wealth in transaction costs. And so we kind of advise everybody that, you should believe what the textbooks tell you. Just hold a diverse portfolio and just hang on to it for decades and build your wealth. But if you're always trying to chase the hot new stock or the thing that seems to be getting all the social media attention, that, yeah, there's great stories of people making tons of money. But then the ones that you don't hear about people that lost a lot of money. And it's just not a good way of investing. It's just too emotional, too kind of, buying, selling winners, or and stuff like that. It's just too behavioral and emotional. We just don't think that that's good in the long run. So yes, you can use calls and puts, derivatives in some circumstances, but I would really caution about making that kind of your focus, because then you're not really in it for the long term. You're not really thinking about being well diversified and what kind of risk that you're taking.
All right, that's some good advice. So I think this is a good point to switch over to an open question answer session. Does anyone have any specific questions for Mr. Longstaff? Feel free to just put it in the chat or unmute yourself, ask a question. Either one works. So open to everyone. So got it. Will hedge funds publicize models that they have used in the past that they were found that were profitable, or will they keep them a secret?
My experience after working with a lot of hedge funds is that, yeah, they try to keep it secret. It's kind of, that's what their idea is. They'll when you go visit with the hedge fund and they want to attract you to invest in the hedge fund, they'll tell you some about their 5 favorite trades, but they will tell you about the ones that worked out well, but they won't really kind of tell you what their decision process is. It's kind of the secret sauce. They want to keep those secrets, and they will tell you about the ones that worked out. So they'll talk about those, but they won't really kind of tell you how they went around making the decision. So, which makes perfectly good sense.
Yep. Just a follow up to that, is there like a case where a model will ever be sold to a different company or different institution or licensed, if that's possible? Or is it always just like, if you develop it, you can use it?
Interestingly enough, the things that do get bought and sold are not so much the models, but kind of like the infrastructure. Like, I worked for a big multi-trillion-dollar asset management firm. People were always interested in buying part of their business, but it wasn't the models. It was kind of what they were buying was their investment procedure. This group had a really good approach of evaluating investments and having a platform, and how do they do their due diligence? How do they roll it out to clients? So it was more like the more practical aspects of running the investment management business. Those were things that were more highly valued than the specific models. So if you have a good process, you have a good investment decision process, and you can communicate that to clients, and clients can feel like, okay, this firm knows what they're doing. They're kicking the tires. They are looking at kind of the important issues. They're going to provide us really good service. Those are the ones that seem to get the business, and that's valuable. The specific models, are actually kind of less important. They're ultimately clients that are going to pay the money or invest want to make sure that there's a disciplined, rigorous, objective investment process. And that's way more valuable to them than the specifics of the model. Just running a good business and servicing clients really well. And firms that are good at that are the ones that are getting bought up, or people want to buy their platform. But it's not, in my experience, it's not that they're going out and say, okay, we want to buy that model.
Gotcha. So next question is, which functions do commodity futures exchanges fulfill?
Well, these are letting you buy and sell things where you don't actually have to exchange the money for the commodity until sometime in the future. It's, we have spot markets, cash markets. If you go down to the grocery store, you can buy a candy bar today, right? Give them the money, they give you the candy bar. Futures markets, you can buy or sell anything, but you can say, okay, I'm going to show up in a year and give you the money, and you give me the candy bar in a year. I don't want the candy bar right now. And so there's just a lot of business situations where you want to lock in the price today, but you don't actually want to exchange the money for the good until the future, you know? And so that's what futures exchanges are. You're worried that you're growing soybeans, and you're worried that over this COVID year, 2022, prices might drop or something like that. There might be a crash in commodity prices. And even before you plant your harvest, there's a way of selling it and locking in the price that you're going to get. If you don't do that, then you're going to take sort of the risk that at the end of the growing season in September, prices may have crashed and you won't even be able to recoup your costs. So there's all sorts of reasons for futures markets. You can use them to hedge and get rid of risk, or you can use them to kind of take more risk. So those are kind of the classic roles we see for futures markets.
All right. So next question. I saw that you've done a lot of research on arbitrage. How do you guys identify an arbitrage opportunity, and what roles does derivatives have in arbitrage?
Well, we do see a lot of what we call arbitrages. A lot of my work is in fixed income markets where it's easy to spot those. For example, we have, like in my classes, one of the simple ones is we're just looking at two bonds that have identical cash flows. You know, same issuer, same cash flow, same date, and they have two different prices. And we see those all the time in fixed income markets because, you know, you can kind of, you know what the cash flows are going to be. They're all part of the contract. So it's easy to see arbitrages. Problem is there's a lot of cases we give our students where we show them that, okay, well, the logical thing here is to go, you know, buy the cheap one and sell the rich one, and then you generate cash today. It looks like an arbitrage. And then we show how that goes spectacularly wrong, and you can lose a lot of money until the prices finally converge. Lots of examples of people losing money trading on what should be a textbook arbitrage. And the issue with a lot of these trading on arbitrages is that to take advantage of it involves taking a very leveraged position. And anytime you've got a lot of borrowing leverage going on, you're at great risk. And there's lots of examples of hedge funds that have blown up because they took too much risk leverage, even though the trade that they were doing was just a textbook classic arbitrage that ultimately would converge and make money. So there's a lot of practical dimensions to that. So a lot of these arbitrages, you really don't even need to use derivatives. You can if you want, but the problem with derivatives is that there's a lot of inherent leverage in them sometimes. So you have to watch out for the impact of leverage when you're trying to take advantage of what you perceive as a arbitrage opportunity.
Got it. Next question. How do things like the current interest rate hikes by the Fed directly influence the derivatives market?
Well, we're seeing some interesting things. The derivatives markets, in addition to being able to allow you to trade, they're also a really good source of information. You know, there's a classic study that was done by one of my colleagues at UCLA. And he went back, going back a way, but he was studying the orange juice futures market. Now, orange juice, we have a lot of oranges here in California, but there's a lot in Florida. And so what was going on was that the orange juice futures market was where people growing citrus were selling their product. But, you know, every time that the temperature gets down close to freezing, it's a scary time for orange orchards, because if it drops just a little bit below freezing and the crop freezes, you can like wipe out almost all of the crop for the whole year, which means that there's going to be a big shortage of orange juice and prices are spiking and everything. So just a couple of degrees of temperature change could ruin the orange crop. And so what people do is they were actually, they go with the official US Department of Agriculture forecast of what they think the low temperature was going to be. And then that has a lot of information. A lot of scientists are looking at, the weather. But then my colleague Dick Roll did the study where he also then looked at the futures market, the orange juice futures market, which is supposedly responding to the same information, right? People are trading on what they think, and a couple of degrees. So it turned out that some of these people that were having orange juice futures positions, they had people outstanding in the fields or in the orchards, all night long with thermometers in their hands and collecting that information. Bottom line is that Dick found in that study that there was actually more information in the futures market about the temperature than was coming out from the weather forecasters, the official USDA weather forecast. So an important role of derivatives markets is providing information. So to get back to your question about interest rate hikes that we're seeing suddenly now, the Federal Reserve is sort of promising us here in the next couple of years, is that we can take a look at the futures markets and see when they think those rates are going to kick in and by how much they're going to kick in. Interest rate futures, you can kind of look at them at 3 months, 6 months, 12 months out to multiple years. And you can kind of see the market consensus of where they think rates are headed. And sometimes it's different than the official policy that is being announced by the Fed. And so there's a big informational role of derivatives markets. And right now we're looking at futures markets to see what the implicit forecast that the market has, the consensus forecast is, vis-a-vis what we're kind of hearing coming out of, policymakers or people at the Fed.
Got it. So the next question, what in your opinion is the most influential model currently used in trading?
Used in trading? What trading and which market?
I think just in general.
In general. Well, I think the models are pretty much kind of asset class specific. So certainly equities are going to have different models than fixed income, energy. So I think each market would have kind of its own models. One though thing we see a lot in the markets are people will use what we call momentum models, right? They will kind of say, okay, if prices go up, we sort of think that there's some tendency for them to continue to go up. So we see statistical models that are kind of forecasting get applied in a lot of different markets. So I guess maybe if there is kind of a common model or a set of tools that's used, it's kind of these models that are looking for momentum in price changes, seeing if you can kind of predict where price changes are going.
Got it. All right. So those are all the questions I think we had in chat. But if anyone else has any other questions, feel free to ask right now. Otherwise, we'll wrap up the event.
Hey, Mr. Longstaff. I just wanted to say thank you for taking the time to share your knowledge on financial derivatives and financial modeling. I definitely learned a lot, but I had one question.
Sure.
Is creating a financial model harder than utilizing the model in the market, or is it vice versa?
Well, takes kind of again, a lot of these models that we use are based on a lot of mathematics, a lot of statistics. So there's a lot of training that goes into this, right? It's but once you have the training, then it usually doesn't take that long to come up with a model, an idea. What kind of statistics, what sort of data do you need to kind of, run the model and implement it, back test it and all of that sort of stuff. So it's kind of a lot just the research that goes into that. So that part isn't that difficult. It's, kind of getting the trading, the mathematical, statistical data background to be able to develop models is kind of the hard part. And actually doing it is the fun part.
Okay, great. So we have 2 more questions in the chat, but I think after that, we'll probably wrap up this event. So first one is, what is the optimal way to value illiquid assets?
Okay, well, that's a area that I've done a lot of research on, and we think about that one a lot. It's got that, we could spend hours on that one. So a thumbnail. A quick way of doing that, one approach that I've taken in the past is to say, when you look at the situation where I give you a share of stock that's completely liquid and you can trade it anytime you want, okay? And say that stock is 100, but that is worth 100. But the same company might also issue a share of stock that's kind of in a private listing, that it's not registered with the SEC. And so it's privately placed and it can't be traded for 2 years, let's say. This is something we call like Rule 144B letter stock. And when that offering of stock is placed, you can observe that it's usually sold at a discount. It can be like a 20, 30, 40% discount because you can't trade it. So you can actually see that people really value liquidity. After 2 years, though, that stock becomes exactly the same as the original stock and goes back to being whatever the other stock is worth. So you kind of look at that and so like, why would anybody want to get a 34, 30 or 40% discount just simply because they can't trade the stock for 2 years? Well, the ways that we would model that, those huge discounts is to say, if you had perfect foresight, what would you have done with that stock in the next 2 years? In other words, by not being able to trade the stock, what doors were kind of closed to you? And if you had perfect foresight, what you would have done is you would have sold the stock at its maximum price over 2 years, right? But instead, because it's illiquid, you can only sell it in 2 years. So if I gave you an option that allows you to sell the stock at its maximum value over the next 2 years, then you should be made completely whole from the fact that you couldn't trade the stock for 2 years, right? So we can kind of at least come up with an upper bound. For someone that had perfect foresight, had a time machine and could time exactly when the stock was going to hit its maximum, if you gave that person the option to sell the stock at its maximum, then that person would be just as happy. But those types of options exist in the markets. They're called look-back options, options on the maximum price. And so you can figure out what the value of a look-back option is and say, okay, that's an upper bound on the discount for lack of liquidity. So that's kind of one approach that we use. IRS uses that approach quite a bit based on one of the models that I put together. So that kind of gives you an upper bound on, what's the worst case scenario. If I had perfect crystal ball, I knew I could time the market perfectly, I would have sold, let's say in 9 months, but because it's illiquid, I had to sell in 12 months. How much would I have to be compensated to kind of make me whole and overcome the illiquidity? So models like that, where you use options to kind of figure out how much you have to compensate someone for lack of liquidity.
Great. So last question, when are forward contracts useful and what are some of the common problems that can affect the forward market?
Forward contracts pretty much have the same role as futures contracts. They're used to buy or sell something in the future. They have an informational role. What's different about forward contracts is that they're usually just done between very large institutions because they end up having a little bit more credit risk. Futures contracts get resettled every day, and so there's only like 24 hours worth of gains and losses that someone would be exposed to. And every day they have to settle up. With forward contracts, you can go years without settling up. And, the market's going against you, you could have, huge losses that, you haven't paid up yet. And so there's a lot of credit risk. So forward contracts are usually just done with large institutional investors that, they have a similar role: hedging, speculating, and providing information.
Great. All right. So I think that would be a good time to wrap up today's guest speaker event. We appreciate everyone coming in to attend the event, and most importantly, we want to thank Professor Longstaff for the time and the opportunity.
Okay, great to be with you. Thanks, everybody. Good luck to you.